Hi, this is Trip Ferguson, CEO of Applied Aerospace Defense. You're watching Taking Stock.
Two minutes to go here into the closing bell. Don't call it a comeback. Down here on the trading floor at the New York Stock Exchange at our session lows, the S&P 500 was down 2.2%. But Peter Tuchman, the Einstein of Wall Street, joins me now down here on the trading floor of the big board. That's not the way we're finishing up. What about this reversal today?
Spectacular reversal, and we've seen it all day. We've had massive buy volume come in for the close. At 2 o'clock, we had $2 billion to buy, and we've kept that as much as $2.5 billion all afternoon. There's like a massive rotation going on. June's one of those months. Reconstitution at the end of the month on the Russell, S&P, huge rebalance. But these intraday moves of 2-3% like this, I mean, everybody's trying to just position themselves. I know, you know, the idea that everybody's trying to raise cash for Friday's IPO, I mean, you know, it's a fun thought, but it doesn't make that much sense. You know, I mean, that's going to open up at some crazy $4 trillion valuation. Right now, we are just moving money around in different sectors, right? People getting out of some of those and getting into others. It's a spectacular market. Intraday reversals in multiple percentage is a big deal.
We also got a few really key pieces of inflation data for investors to chew over. We're not that far away from the next Fed decision, so a lot of macro forces at play here. For
so many components playing into this day, and each day going forward.
The Einstein of Wall Street, Peter Tuchman, the great team from AT, set to do the honors. More Taking Stock coming up after this. And there you have it, well off session lows. Your final tail of the tape on this Tuesday, June 9th, the S&P 500 in negative territory, only 0.26%. Again, it's all relative given where we were right around 1 o'clock in the afternoon. The Dow 30 up 0.17. The New York Stock Exchange Composite Index up about 0.7. The small caps up 0.4. Home Depot, Sherwin-Williams, and Nike, the best performing Dow names. We'll do a little bit more of a deep dive onto Nike coming up in just a bit. Salesforce, Apple, and Cisco, the Dow 30 laggards. Apple, what a story that's been. Investors continue selling during day 2 of the Worldwide Developers Conference in Cupertino. Catching a bid here on Wall Street today. The airlines up big on falling oil prices. Alaska Airlines, the best performer of that bunch. Biotech, the home builders as well, but otherwise all the high-flying, high-beta sectors we talk a lot about, software, semis, quantum memory, all down across the tape. With the VIX, the so-called fear index, implied volatility on the S&P for a time duration of the next 30 days, reaching its highest level since early April. Let's bring in a man who knows his stuff far better than I do, also a very good friend of mine, the great Phil Rosen, Chief Market Strategist at ProCap Financial. My man, nice to see you here today.
Thank you for having me.
So, I mean, it's funny, if you and I were doing this conversation like 3 hours ago, it might look a lot different because this was quite the rally into the close. For the most part, we're still at these all-time highs, but between Friday's selling and today, are investors maybe growing a little bit more cautious of the market's year-to-date rally?
I think so. The jitters are, I think, to be expected after this strong of a rally year-to-date, and if you go back even a year and a half, we've been ridiculously strong in this bull market. But again, if you zoom out beyond 3 trading sessions, the bull thesis is very much intact. Earnings have been unbelievable. Earnings expectations continue to go up for the coming quarters, and analysts are actually getting more optimistic at this point in the year, which is very unusual because usually by now they're revising lower, but we're still going up. So to me, yeah, we're going to get a few blips on the radar. It's not going to be a straight line all the way up, but again, the earnings story is so unbelievable, the demand story is so unbelievable, and supply for all these AI chip makers are still trying to keep up with all the furious demand right now.
Phil, I don't know if you heard, there's a pretty big IPO happening on Friday of this week. A lot of people are chatting about it. Do you view the SpaceX listing as the most important IPO of our lifetime, maybe the most expensive IPO of our lifetime? How are you viewing it a few days out?
It's probably both true on those fronts. I mean, look, if you're a retail investor who's looking to buy something on day 1 of trading, you're probably in the wrong game. I don't think that it being SpaceX, it being Elon Musk, really changes that calculus. I I think SpaceX will be a fantastic company long term. I'm a big believer in Elon Musk. I think he's a world-class entrepreneur and founder, but that does not mean I'm buying into an IPO in the first weeks or even months of trading, because typically over the first 6-12 months, these things don't do that well anyway, even if it's a $2 trillion valuation out the gate. That actually makes me more nervous, not less. I'm not a buyer of it, but I do believe in the company and Elon Musk.
We know that the generals who have led the pack over this bull market the last few years, we affectionately refer to them as the Mag 7. Maybe, as our mutual friend Jay Woods would say, performing a little bit more like the Lag 7 in favor of the so-called other 493. A bit of a momentum shift. What are you following there?
You know, it's interesting that the 7 largest companies, or 7 of the largest companies in the market, are actually underperforming the S&P 493 this year. I think the 493 is actually doubling that performance year to date, which is very unusual. It's a complete flip from the last 2 years. So look, if you've been long the Magnificent 7, you've done extremely well, pretty much since ChatGPT launched 3 years ago. But that is reversed in the last few months, and you've also seen dispersion within the Mag 7. Alphabet's done very well, Nvidia's done very well. Everything else is kind of middling to negative performance, and I think we're seeing this rotation into other chip winners. You've seen Micron go on this unbelievable run. Marvell is another one that's been unbelievable. Taiwan Semi, that's a big winner. AMD, all these other names have been exceptional, and the Mag 7 have kind of been forgotten, even though they're the only group with a nickname. So, you know, I still like Google a lot. I like Nvidia a lot, and even Amazon I'm very bullish on. But as a group, it's been pretty meh.
I feel like we need the Mess 7. Maybe that the Mess 7. Also, maybe we need new groups, new acronyms. I remember asking Dan Ives a few years ago if you had to add one stock to the Mag 7 to make it the Elite 8, what would it be? His answer 3 years ago was AMD, because he really liked Lisa Su. That take has aged pretty well over the last 3 years.
I mean, he's been right on a lot of things. I know people think he's too bullish. I disagree. I think he's been spot on. The AI trade has not slowed down by any means. If you look at the market today and maybe on Friday, yeah, you might come to the conclusion that we're getting a little frothy. To me, I'm very bullish though, long term.
Phil Rosen, Chief Market Strategist at ProCap Financial. My man, come back anytime.
Thank you for having me.
We'll do it again soon. Jeff will head this way. Here are the latest analyst calls that move the tape here on Wall Street today in no uncertain terms. We'll start with KBW upgrading Toll Brothers to a rating of market outperform, saying the fundamental tone for the home builder is improving. Shares up 5% on the day, up 6% year to date. Next up, Goldman Sachs reiterating Micron as neutral, lifting the price target from 400 to 900 a share ahead of earnings a few weeks from now. Micron up 230% year to date. That's right. Finally, Deutsche Bank reiterating Birkenstock as a buy, raising its price target to 51 a share. They see a compelling capital allocation angle within the stock story. Shares up 10% year to date. Jeff, we'll take a look here at one stock that calls the New York Stock Exchange its home. And it had a nice day here. Nike up 3.2%, one of the Dow's leaders, despite being the second worst name in the Dow year to date. Shares have fallen all the way back down to their 2014 levels. Goldman's got a $52 price target. Analysts there say they're hopeful the company can catch a bit of momentum from the World Cup. UBS analysts, however, warning at the very same time. They say the turnaround for Nike may take a fair bit longer than investors had previously been anticipating. Last week at Money 2020 Europe in the great city of Amsterdam, FinTech TV's Anastasia Kinski sat down with Moet Bendy of Carrot to discuss how their interviewing platform is building an AI-ready workforce. Take a look.
Welcome. I am here at Money 2020 Europe in Amsterdam, and I'm very pleased to be joined by Mo Bende, who is CEO and co-founder of Carrot. Mo, thank you for joining me.
Lovely to be here.
So, tell us a bit about Carrot and what it does.
Yeah, so Carrot works with large banks like HSBC and Citi and other fintechs like MasterCard and Amex to help them measure and elevate the quality of their engineering talents. The way we do that is we've actually built a service to interview software engineers. We've now interviewed over 600,000 engineers around the world. And then we've built data to help our clients benchmark and measure the quality of their talent. We do that across all their new hires, their contractors, the folks that they will get from a Deloitte or an Accenture, and their existing talent.
It's such an important thing. I mean, it's the most expensive asset that you have. So making the right decisions, just crucial. Is AI making engineering talent more or less important in financial services?
I would say that the right engineers are becoming way more valuable. We recently did a survey of 300 CIOs and CTOs around the world where we've been asking them the same question every year, which is, how valuable are your top engineers? And the percentage of people saying, yes, our top engineers produce 3 times more than everyone else has dramatically increased with AI. So the engineers that really harness and leverage AI are producing so much more. And so to answer your first question, yes, that is becoming more valuable. In terms of every company becoming a tech company, yes, but there's more to it. I think to do good engineering at a FinServe, you can't just know engineering. Yeah. You need to understand the regulatory environment, the governance, how the products fit. And so I do think engineering at a bank or an insurance company, there's more context and domain expertise required than just the pure software.
I mean, absolutely seeing, exactly what the activity is, but then harmonizing that with what the activity can be once transformed with technology, and just getting the people who are going to understand how to deal with the different stakeholders, create a culture for transformation.
That's right.
Yeah, fascinating. The differences between how financial services firms approach AI adoption as opposed to big tech companies. You slightly touched on this before, but that it's clearly a changing landscape in terms of the big embedded technology within a company versus outsourcing. What are you seeing in those trends?
I'd say 3 things. One, the software ship cycle is really changing. So at a lot of big tech companies, they've already been used to, maybe shipping daily. Most banks aren't putting new software out daily. But I do think that with AI, the velocity of net new things that are still align with the governance and the regulatory framework, I think that that's going to expedite significantly. I think a second big shift is we're just seeing more innovation and experimentation coming out of these organizations. Many of them have dedicated AI teams, dedicated units. And I think third is the way a lot of companies are defining the engineer of the future is changing. It is changing from someone who will just code to someone who understands that triumvirate of the customer, the technology, and the governance. And so a lot of what we work with our clients on is defining what is that engineer of the future for their organization. And by the way, I think it'll make a lot of organizations far more compelling places to work as well for the best talent.
Yeah, and in a landscape where we're seeing a complete change in talent and employment, a new generation coming out. This is the pandemic generation now who are going into work, and they have a completely different idea of what is useful for them and what is useful for a company. It's very much a changing landscape. Thank you so much for joining.
Lovely to be here. Thank you so much for your time.
Welcome back to the show. John McCluskey joins us now. He is the president and CEO of Alamos Gold. Nice to see you again.
Thank you very much.
You're a producer that operates gold mines throughout North America, also sells the gold you extract from those mines. Gold itself, as an asset, about flat for the year, price-wise, but up 30% in the last 52 weeks. What does that mean in terms of the environment to be a gold miner today?
It's been a great environment. I mean, our margins have never been better, even with the recent pullback in gold. Our all-in sustaining costs are well under $2,000 an ounce. We're about $1,600 an ounce, and gold is still trading north of $4,200. So we've got a marvelous business going. And I think it's a great opportunity for anybody who's been looking to get into the gold space, because normally I don't think you would have seen this pullback in gold. I think this has been related to the war in Iran, which was somewhat anticipated. And if you look back, right around the time that the Americans and Israelis started bombing Iran and Lebanon, that's just about the time that the gold price started to come down and the oil price started to go up. So I think that's been a trade, and I think that trade eventually has to end.
In terms of your core business, why is exploration of new reserves such a big priority right now, John?
Well, it's been sort of the heart and soul of our company all along. And we've always bought assets that looked small and rather overlooked. And then we've applied our exploration expertise to them, and we've turned into very big and valuable assets. Case in point is our Mulattoes project, which we bought for under $10 million back in 2001 when gold prices were under $300 an ounce. We invested heavily in exploration. We're still producing there. It had less than 2 million ounces when we started. We've mined over 4 million ounces and it's still growing. We've made over $1 billion in profit from that mine. That was initially a $10 million investment. So we've done it again with our Island Gold project. We've done it with multiple projects, but Island Gold is the one that's really grabbing the imagination right now because it's a major discovery. It's very high grade. It's in Canada. When we took it on, it had less than 1 million ounces of reserves. We're now over 5 million ounces of reserves, and that's net of 2 million ounces of depletion. So, you know, it's been a phenomenal discovery for us, and we're adding those ounces at a cost of roughly $13 an ounce.
Wow.
And you know, when we bought it, the gold price was $1,300. Now gold prices are $4,200. So I think we've demonstrated that we know how to buy assets that are undervalued. We buy them in markets that are generally very low. We buy them when the gold prices are low, and we make a ton of money for our shareholders on all fronts.
John, what would you say is the biggest moat that you could have in the world of gold mining?
I think the best thing to have are really high quality assets. And if you've got good quality assets those are gold mines that are located in very safe jurisdictions with long life reserves and low cost production, those three attributes, if you can find those kind of assets, you've built yourself a really big moat.
John McCluskey, President and CEO of Alamos Gold. You're always welcome back to Make the Case. It's nice to see you again, sir.
Thank you.
Take good care of yourself. Don't go anywhere. A lot more Taking Stock coming up live from the transport of the big board right after this. Nicely done. Thank you, sir. All right, welcome back to the show. Time now for the latest headlines in the world of fintech, crypto, and artificial intelligence you need for your Tuesday afternoon. First up, the crypto majors all down about 2%. Bitcoin reconsolidating right around the 62,000 level. Next up, Apple finally unveiling its long-awaited overhaul of Siri, turning the popular voice assistant into a fully conversational AI companion designed to compete with Chat, Claude, and Gemini. Finally, House lawmakers debating a series of crypto bills that could delay taxes on staking and mining rewards and bring digital asset rules more in line with traditional investments. Despite driving past it every day, most New Yorkers have no idea that the very popular Brooklyn Navy Yard is actually a hub for innovation. Cheddar's own Chris Castellino has more in part 2 of that story.
Thousands of New Yorkers drive on the BQE every single day, passing these same old familiar buildings, without stopping to think, what's inside them? Just beyond the off-ramps, hidden inside old warehouses, are New York's secret labs, quietly building the future.
This is where a lot of interesting raw materials are actually designed and developed.
We effectively delivered in 30 days what most people around the country couldn't.
We're primarily focused on the amphibious vehicle to detect mines and explosives.
This is where we have a collection of tens of thousands of microbes.
In this episode of NYC Innovates, we'll take an exclusive look inside the abandoned military base repurposed into Brooklyn's boldest tech park. We'll reveal the groundbreaking companies working behind the scenes and what it all means for New York. Let's go. Our next company has been building the future of healthcare in a warehouse just up the street. 10x Beta is a health tech venture studio that doesn't just develop products, they build the companies around them.
10x Beta is known for high-speed development or new product introduction. We have a prototyping facility that is the noisiest part. Then we have an assembly manufacturing facility, and then we have the development facility where we are sitting now. When we invest in companies, in the current portfolio, we have minority stakes, founding stakes, and companies that we have incubated from scratch, where we own the whole company.
In March of 2020, as the COVID pandemic spread across the city, ventilators were running out. 10x Beta was there to provide that solution for New Yorkers.
We got the call from the mayor asking us to partner with the city of New York to make the backup ventilators for New York. We developed a new bag squeezing ventilator. It had all the safety features of a modern $30,000 ventilator, and we shipped 3,000 units. Since 2020, we have miniaturized that 110-pound device down to a 6-pound device. And so it's now pre-FDA, and we are envisioning sort of like where it will live in the EMS toolkit going forward.
Today, 10x Beta is developing a modular and mobile healthcare platform to deliver urgent care to rural Americans in under 1 hour.
So we developed a modular platform, a system that consists of 3 primary parts: a software layer that connects everything end to end from care planning all the way to logistics management, an IoT layer of modules that houses consumables, equipment, and other parts to deliver that care, and then an intelligence layer that helps manage the care while inside the vehicle. So it's a very fluid system that we believe will be one approach to scaling healthcare across the US.
The Brooklyn Navy Yard isn't just about the companies inside its walls. It's become something far bigger, a place for workforce development, education, and community access that's reshaping what economic development can look like. Green traces that inclusive vision all the way back to the workers during World War II.
In that time, the Navy Yard employed tons of women. I think we had 7,000 Rosie Riveters here at one point. And it employed tons of Black Americans at a time where that was not popular. There were a lot of queer New Yorkers that were employed here and felt safe and felt like they could come practice their trade or skill and not be judged. And so it was this really welcoming place. We partnered with some entrepreneurial folks at the New York City Public Schools Department and created a next generation technical high school here called the Brooklyn STEAM Center. And that trains high school students so they graduate with college credit and always with at least 2 professional certifications.
It's that same idea, science in service of everyday people, that drives Next Step Laboratories, a company developing the active working materials that go into the skincare, cosmetics, and hair care products that millions of consumers use every day.
So Next Step Laboratories is an innovations and material science company that develops active materials for consumer goods, specifically cosmetics and personal care. The founders of Next Step Laboratories come from companies like Unilever, Revlon, and some of like the largest personal care and consumer goods companies on the planet, and worked in research and development in a lot of those places, and figured out that there could be a lot more done to make the things that those companies produce a lot more efficient, a lot more elegant. We are using raw materials, putting them into different formulas to see whether things are working the way they should, and then interesting actives are also developed here from ideation all the way up to scale up. We brought in high school students recently to talk to them about cosmetic science, formulation, and things like that. And they got to make their own products. It was a really like hands-on, interactive kind of day for them.
While most New Yorkers drive right past these buildings every day without a second thought, it may have become one of the most important innovation campuses in the country. So where should we explore next? Let us know in the comments below. Your suggestion might just be our next episode. For Cheddar, I'm Chris Castellino.
All right, welcome back to the show. Time now for the latest headlines in the world of startups, raises, and rounds. First up, OpenAI confidentially filing for an IPO, joining Anthropic and SpaceX in a huge AI IPO wave, now valued at more than $3.5 trillion total combined. The numbers are insane. Next up, Bloomberg reporting SpaceX seeing demand for multiple times the shares that are even available for Friday's listing, with some institutional investors reportedly placing orders for more than $10 billion each. Finally, digital asset trading firm GSR winning FINRA approval to acquire a U.S. broker-dealer. In doing so, gives it a regulated platform to help companies raise capital and bring tokenized assets to market. And now Money 2020's very own Scarlett Sieber is back to explain all of the ways that fintech companies actually make money. Take a look.
Welcome back. I am Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. We're going to be looking for revenue in the places marketing usually ignores. Today we're going to be talking about Veem, a cross-border payments company built for paying suppliers, not impressing consumers. And this matters because Veem helps businesses send and receive international payments faster, cheaper, and with more visibility than traditional banks. So how does Veem actually make that money? First, foreign exchange margins. Veem earns on the spread when money changes currencies. Small percentages, but meaningful volume. Second, transaction fees. Each international payment contributes revenue, tied directly to that trade activity. Third, business trust. Once a company trusts a platform with an international supplier payments, it does not switch back casually. Now, why does this matter right now? Global commerce has not slowed down. It's just become more cost sensitive. So companies scrutinize every single basis point. Veem wins by taking less and doing it reliably. And that is how Veem actually makes money, by monetizing global trade flows without trying to own the customer relationship. Do you have a fintech that you want unpacked without the hype? Put it in the comments and it just might make the cut. In the meantime, back over to you.
Tomorrow morning on Wall Street, we get the May CPI inflation print crossing the wires for investors to digest at 8:30 a.m., plus the latest quarterly results from Chewy, J.Jill, Oracle, and Stitch Fix. Thank you for watching today's edition of Taking Stock. Have yourself a terrific Tuesday night. We'll see you again live tomorrow. It is Tuesday.